Hey, it's Richard with Matthews Wealth Management. We're going to do the April 22nd market update video here. First page, I'll just jump right into it. First page here, I've got a couple of quotes. I think last month's video got a lot of views and a lot of interest, so I'll stick with some quotes. I guess that's good. So the first one we're going to do, there's enough cash in the financial system, and there is an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure there is enough cash in the banking system. That's a quote from Neil Kashkari, right? That's just weird. And there's a theme of all these Fed people and their names. I find it just hilarious. But all right, so that's the plan. No matter what it takes, money will be printed to solve the problem. I don't think they fully understand the problem. And if we continue, this gets even more interesting. So I think we are not paying enough attention to the law of unintended consequences. Take any decision that is a massive decision, like the decision that we need to spend to support the economy. At that time, we did recognize there may be too much money in circulation with too few goods, but didn't quite think through the consequence in a way that up front would have informed better what we do. Kristina Georgieva, director of the International Monetary Fund. Whoops. I guess that's what she's saying actually is, whoops. There's too much money and not enough goods. Supply is the problem, not demand. Printing money does demand. The whole Keynesian philosophy is based on aggregate demand. So spend money. If you save it, you're evil and hurting the economy. It's insanity, but that's what we do. I think they realized it, but they did it anyway, and we're going to keep doing it. These are our leaders. These are our expert economic people. So, oh my God. Just to wake you up a little bit, this isn't a real, this isn't rocket science. I think economics is looked at as like some big mathematical formula. It's not. It's common sense. It's doing what you need to do with your scarce resources to make your life better tomorrow than it is today. Pretty simple. Everybody's an economist. When you make a decision to buy, a brand name Lay's potato chips as opposed to, the Walmart brand or whatever, you're an economist. You're making a decision on, is it worth the extra money? And it may be. It's all subjective is the point. These people think that they can run everybody's lives. They don't understand what you value. They understand what they think you should value. And this is the problem. Now we've got massive liquidity, and we're going to have to talk about that too. So let me jump in and get, this is terrible for me to have to get into, but a voice of reason comes from Russia, of all places, right? For any national financial system to be sovereignized, weird word, but he's Russian, I guess, it means a payment must have intrinsic value and price stability. Nikolai Patrushev, he's not a good guy, right? He's KGB, he's Putin's kind of advisor. He's also the chief guy that's structuring their entire financial system right now, and he's right. Okay, so Bitcoin, it has to have price stability. That's why it's not a currency, y'all. It has to have intrinsic value. I think Bitcoin says scarcity has value, but NFTs, we saw those plummet, right? So intrinsic value is based on production. It's based on labor. It's based on parts of an economy, not on scarcity and not on market fluctuations. And so price stability as you print to infinity is not a thing. Our financial system is not going to remain sovereignized, especially in competition to what's on the horizon. So I'll jump on with that. The ruble is now, it's 65 rubles to $1. You remember we said it was, it went from 81 and it dropped down to 131, maybe it was 82 to 131 and back up to 82. And I said if it dropped below 75, that's when we're looking at the equilibrium of the ruble to the ounce of gold. That was maybe, it might have been March, it might have been February that I did that video, but we're now at 65. So the value of the ruble is now pegged to gold, and they actually announced it. Yeah, that's our goal. We want to back our currency in assets, and that's how they overcome these sanctions, with sound fiscal policy. So Russia, China, India, Saudi Arabia, they are all looking at gold and commodity-backed currency. So the way that the U.S. works since 1971, the dollar became a debt-based currency. There is no asset backing the dollar anymore. So it used to be in 1970, you'd take your $100 bill and you'd go to the bank and you'd say, I want to redeem this for however many ounces of gold my $100 will buy me. And it was roughly three ounces back then. It's like 35 bucks per ounce. It's now $2,000 per ounce, just so you can see how your dollar is valued. In 1971, Nixon ended that gold standard. It wasn't the real gold standard. It was a paper gold standard. But you could exchange your $100 for $100 worth of gold. And then when that ended, you can take your $100 and you can still exchange it for 250s or 520s or 101s. You're still exchanging your denominations of debt for other debt. There is no asset on the other side of the book anymore to create a $0 balance, right? So you're exchanging debt for debt. We're living in debt, and that's how this infinite is even possible. So you can thank Richard Nixon for what we've got here and how these, I'll just call them idiots because they are, how they are running away with this terrible system, and now we've got to compete with people who are going to be gold and commodity backed like we should have remained. So anyway, let's talk about what that does. All right, we talked a lot 2 months ago, I know for sure, about fertilizer costs, right? So why does that matter? Yeah, costs are going up, but fertilizer is what we use to increase the yield of crops for food supply, right? So if we have fertilizer costs going up, and if you've noticed in the news, there are a bunch of fires and explosions happening at all these packaging and processing facilities all across the U.S. And actually, there's more across the world if you pay attention to that. Heat waves, India and Brazil's had some interesting issues with their weather, but you've got some weather issues that are also going to create a supply problem here. Poultry epidemics, right? You have avian flu, bird flu, whatever you want to call it, doesn't matter. But all of this means our supply of food, and you can apply this to all industries, but I'm specifically talking about food, is dropping. So when we drop our supply, what happens to prices? They go up, duh. But it's more important than just the money, right? I think it was last month I said you can, no, I'm sorry, it was last year in September. I've been running this little 40-second clip from our September reallocation video. Go to the 5-minute, 40-second mark. It's amazing. We went higher end commodities, just in general. We were already very heavy on commodities, specifically oil, which has been awesome for us this year, but went a little bit heavier into oil. With what's happening in Europe, you're going to see a lot of stuff changing as far as how people think of green energy and then at what cost, because you can print dollars, you can't print electricity. So we'll see what happens this winter. Gold is just ridiculously cheap right now. Silver is even cheaper if you go by those ratios. So I like commodities right now. I just think that inflation shows up somewhere, and that's usually in the factors of production, which is what commodity markets are for. It's supposed to protect and hedge against future increase of inputs. So but what we were talking about then is that when we're looking at the supply overall, you can print more money, as these people like to think solves problems. You cannot print, I said electricity back then, but now we can't print food, right? So coffee, we're expecting 15% less supply of coffee this year just because of all of these input problems. Rice, we're expecting 10% less rice. And in case y'all didn't know, rice feeds a huge amount of people on this planet. It's actually one of the preferred. Wheat is a big one, corn, and then rice. 500 million people will not have their rice this year. That's what that negative 10% means. So if you care about people, if you're like, oh, the whole world needs to get along and be friends and feed the world and the hungry, we just created 500 million more starving people in the world because of all the costs and stuff and these explosions and fires and an epidemic and heat waves, and you can call it climate change or whatever, but I would say the fertilizer cost is what's really driving the 10% less rice. because they're just not using it. They're not going to pay that money because it doesn't pay them back down the road, right? These people are starving. These people are not really paying a ton of money. It's not like there's profit in buying this expensive fertilizer, right? So fertilizer costs and sanctions and just dropping the supply that we really want to deal with, because it's China and Russia that produce most of the fertilizer, we're going to make a lot of people hungry. Good job, everybody. All right, also, this is up on the lines of how these politicians and experts believe that they should fix the world. The Bill Emerson Humanitarian Trust, this is a decision Joe Biden has made, is going to deplete all of its resources to feed the international communities that are going to be subject to the starving. So it's $670 million that we are going to deplete the entire fund and give across seas so that these people don't die. Okay, cool. What are they buying? You can spend the money, man. It's the same thing. You can print money. You can't print food. How's this going to... Well, we're going to need more money. We're going to print to infinity, and that'll solve it. They can eat the cash, right? Maybe there's something good about eating cash. I don't know. Good Lord. All right. Yeah, I'm frustrated. I'm very frustrated. And I think people would rather me be me instead of like this polished news, hey, here's the market update. This is how I really think. So I'll be a little less filtered. I'm still potentially going to edit something. All right, so let's talk about overall inflation. Inflation ran 8.5% in the year ending last month, while nominal wages grew only 5.6%, a decline in inflation-adjusted wages of 2.7%. So we could talk about raising minimum wage. We could talk about I don't care about a gallon of gas as long as I'm not being bombed by Russia and all that garbage out there. But fact of the matter is all this money printing and the way that we've handled our economics, our basic Econ 101 here, is people are hurting more. What does a negative wage growth, nominal, actual inflation-adjusted wage growth mean? It means you can buy less stuff. It means that your standard of living just dropped. That's not good. And who does that hurt the most? Does that hurt the big banking executives and the top 1%? Of course not, right? Who's it meant to hurt? The little guy. But now it looks like, well, we just need to raise the minimum wage, and that's going to be fair to the little guy. No, that's going to raise inflation. You're chasing your tail. The problem is how we've created 8.5%. Not that we had an increase of too little in our wages. That's insane. So we're just chasing something that we're creating and thinking that continuing it is going to fix it. Literally the definition of insanity. So anyway, that was Jason Furman, a Harvard economist. He was actually one of Obama's top advisors that came out and said, uh-oh. But now, how does this get politicized? Oh, we need to raise the minimum wage. Okay, let's raise it to $1,000 an hour. Did it fix it? Nope. The costs went up even more, and they're still going to be down next year on their inflation-adjusted wages. Think of a bigger picture. This law of unintended consequences, it's just one extra step of thinking, guys. It's not like you have to understand how to solve all of the world's problems. Just think a little more than you're doing. These little headlines that you read and repeat, think a little more. That's it. So specifically, who got hurt, right? Who's really most effective? If you make less than 20 grand a year, your income went up $500 last year. Okay. Your expenses went up $1,900. So really, you get to spend about $120 per month less than you got to the year before. Okay, and that was during COVID too, of all times. So very interesting, right? So these people got hurt by about $100 a month of what they have to spend on things they really need. They're not buying luxury items. So this really hurts them. If you go to the 20 to 40, they actually had a net gain in standard of living. Okay, I don't know if that's good or not, and it was only probably like $20 a month, but still, okay, so there's some positive in there. But from the 40 to 60 group, they had an increase in income by $2,100. Their expenses increased by $2,700. They took a $50 per month loss, right, as far as standard of living. Guess what? Everybody else went up in their standard of living, right? Is it because minimum wage is too low? Nope. It's because inflation is too high. How do we create the inflation? By these people running the show, okay? It's what they're doing. I believe it's either ignorance or on purpose. Both are terrible. Both means that they should not be qualified to do what they're doing. Okay, that's my belief. It's an opinion. There we go. It's not a, yeah, okay. It's my opinion. All right, so Bullard is a Fed guy. Bullard, Kashkari, Brainard. It's so funny, right? Bullard, by the way, bull market means market's going up. It's like, yay, we love the market. He's actually one of the most hawkish guys, which means that he's actually kind of recognizing there is a trade-off in inflation with their policy. He's calling for the federal funds rate to go up. Duh, should have 12 years ago, but good for him. Brainard, she is saying it's time to start selling these assets off of the Fed's balance sheet, which we'll cover in the next segment. Together, and it's pretty much a consensus, I guess, at this point, that we need to pull about 5.5% of the liquidity out of the market, out of the economy. That's probably a better way of saying it. All right, and we've started doing that, and we'll get to that next section here where we talk about finally we see the balance sheet shrink. But they're starting to sell some of these bonds. They're starting to raise the rates, right? So we've still got about 3% more liquidity on the way that's coming out of the system, right? And so what does that do? That causes all sorts of issues because we've been living on free money, and now that it's the consequence of inflation, we're way too late to the game. And it's actually painted us into a corner. But Solomon Tedeschi, he's a quantitative guru guy. He does all sorts of behind-the-scenes calculations with liquidity and banking and reserves and reverse repo and all this good stuff. Like if you want to be a super nerd, he's a good guy to follow. So at about 1%, the market's going to implode. Well, we kind of saw that in April. We kind of saw that all first quarter and also in April. And ouch, when we hit the 1%, it's going to be rough. Today, we're in May, and it's May 6th now. So yesterday, the market shot way up because we kind of took 75 basis points off the table for June. And I think we're just going to increase in 0.5% increments going forward. And that's all well and good. May, we went ahead and did our first half. Well, whoops, in June, when we do the second half, we'll see if Solomon's right. Like, so it's a bunch of math involved, and you know, it's math that's not based in the Keynesian economics way of, oh, we just do this, push this button, pull this lever, and everything's fixed. That's a garbage philosophy. But anyway, his thing is we've created a problem, and when this happens, this is the likely outcome. We'll see if he's right. Markets imploding would be stock market and the bond market. So the last time that we had this 8% plus inflation, our federal funds rate was actually at 12%. All right, and we're now talking about maybe going to 3.5%. So the way things worked in the 80s, which was after Nixon, is different than today. After we've printed all these trillions of dollars and bought all these additional trillions for a balance sheet, the problem is we've just created a cap of what the market can handle, and they're pricing things in. It's just, this is a nightmare that we're walking through here. Most importantly, first quarter GDP came in negative 1.4%. So we printed all of this money. We don't inflation adjust these numbers, GDP, by the way. So we printed, what, $6.5 trillion or $7 trillion. We've got $9 trillion on the balance sheet. All these trillions of dollars, and we contracted our spending and production in this country. That's bad. In fact, that's the definition of stagflation. So everybody who says, oh, stagflation is not coming and inflation is talked about way too much and we can keep this from getting out of hand with these people. Sorry, won't get into it too much. We also continue to increase our excess jobs. Those are jobs available more than people who are even looking. So we're now at 5.2 million more jobs exist than people even looking for a job right now. That's a problem as that continues to escalate and GDP drops, and we're going to raise interest rates, and we're going to sell more bonds into the market from the Treasury or from the Federal Reserve. This doesn't look good. And then I'm going to end with this. This really doesn't tie in. It's hard to get like a segue to it, but I thought this was interesting. Came across an article about what is the amount of savings that each age group has for retirement. I mean, we mainly do retirement planning here. So I thought that was interesting. I kind of want to see what does the world look like for me to go market to and bring on new clients, which we're bringing on too many. We're going to be hiring some people this year, which is going to be awesome. So we'll have capacity to bring on more clients, but let's see what my market looks like. If you're under 25, median, I believe, is actually a warning sign economically. Average is what I'm looking at for marketing. So median for somebody under 25, they've got $2,200 saved. Okay, well, they're young, they've got time, they're not thinking about retirement. They may not be automatically opted into their 401k, or they may be working part-time and not getting 401k or a side job and not thinking about savings. And it is what it is. I was that age once. I know what that's like. However, on average, it's $6,700. That's a big swing between a median and average. In fact, most of these are. But $6,700, those are pretty good 25, 24-year-olds, right? So, okay, there's a big gap there. So there's a lot of zeros affecting the other end of it. Median from 25 to 34, that's 13,265. 13,265, that's kind of cool. All right. So those people are starting to get their act together, I suppose. That still seems a little low, right? You think about creating enough income from when you retire to last you for 30 years. Yeah, social may or may not be there, but all right, let's pick it up a little bit. 35 to 44, this is my group right here. The median's only 32 grand that they've got put back. I mean, if you go from the 25 to the 45, that's in 20 years. We only got 30 grand. Weird. Okay. So, but now look at this. The average in my world is 86,582. Okay, cool. In fact, I think I have a few of those clients that are bringing the average up way above the median. So that's the thing that I'm noticing here is that the average, there's a type of people in an age range that are doing it right. That's who I want for clients, by the way. I want the people that are thinking about this and engaged in this and care about this. 45 to 54, really got to get your act together. 65 is creeping up on you pretty quick. 56,000 median. Well, if you're earning 50 grand a year, that's 1 year of retirement. What are you going to do for 29 years? Go back to work, I guess. But yeah, pick it up. But then we look at the average. Wow, 161 grand. Still not a lot of money for where you are in life, I would say, for the average, but that's a tremendous gap. That's over 100 grand difference between the median and the average. There's just a tremendous split between how people are saving, the good retirement savers, the workers, the doers, the put it back, and those that are just like, I'm not even going to save. I don't even care at this point. Somebody's going to take care of me. And I've heard a lot of that, actually, talking to people one-on-one, anecdotally. There's a lot of that thinking around here. 55 to 64, 84 grand. Oh my gosh, you just don't care. You gave up, I guess. Versus 232. All right, you're still getting there, but that's not going to last you about, what, 5 years in retirement? This is a major issue. There is not enough savings to retire the millions of people looking to retire. So what does that do? Well, they go on Social Security, and then they say, we're not getting enough Social Security. Well, have you looked at how Social Security is going to be funded? 30 years from now, what does retirement look like? Yeah, culturally, we've made a lot of mistakes here. 65 plus, these are people that should be retired already, right? So 82 grand. You're not really retired. In fact, I don't think anybody, when they come in here and they say, yeah, I would like for you to help me retire. I'm going to sit on a porch and rock and see my grandchildren and not do anything. Okay, well, nobody does that. And I think a lot of it's because they have to keep working. They want to work in something that they enjoy. They want to be productive and feel like they're doing something. They need to be engaged in relationships. There's a lot of justifications for the fact that that is not enough. That is not even close to enough. If you look at the average, 255 grand to retire, that is not enough. Even if you're like spending 2 grand a month on your core expenses, living expenses, that would be like utilities and cell phone, food, clothes, gasoline, that kind of stuff. We're not talking mortgage, we're not talking healthcare, we're not talking debt, we're not talking taxes. We're just talking about core living expenses. 2 grand is pretty modest, pretty average, I would say. We get some clients that are maybe in the $3,500 a month range. They're spending a lot of money because they also have all those taxes and everything else on the side. But for 2 grand a month, that's not going to last you long, even with Social Security. And there are no pensions really anymore. Sorry to a few clients that have pensions. But on average, our client base, we're We're managing around 400K per, but I would say their net worth is more like 800 per. So yeah, we're working with people that are wealth-minded, that are thinking of legacy, that are thinking long-term, and have been thinking long-term about how they're going to provide for themselves, remain independent, and feel like they're productive for society, instead of having to react to, uh-oh, I didn't plan very well. So that's just kind of a plug to get you thinking about this. So it's not just news, it's like a call to action. Get on it, start saving. So we'll come back, we'll do the M2 money supply and the balance sheet. All right, we're back. We're going to cover the M2 money supply and balance sheet for April 2022. Currently, we're at $21,809,700,000,000 in circulation. And that's according to M2 on the revision where they called it SL and redid everything in history, so we can't compare it. But anyway, from last month, a month ago, it was 21,750,000,000,000. So we increased our money supply by 0.27%, and I'll get to this intermediate part here in a second, but it's a continued increase, right? We're still printing more money. So over the last year, we started last year at the end of March with, with the end of April, 19,853,700,000,000. So we've actually increased our money supply by 9.85%. And if you're new to this, we're equating this to inflation. It's a monetarist type idea, I guess, that just the money supply is what creates price increases. And that's true. It's a major input. It's not solely the issue, but it's tracked out, right? So first segment, we talked about the 8.5% increase of prices in general, and you can calculate that in many ways. But we're tracking consistently. So we weren't coming out of left field, in the middle of COVID saying all this money printing is going to create inflation. It was pretty obvious. And so we've just been tracking it to prove the point that we're right and the people that are making decisions are wrong and have been wrong, and they're admitting that they've been wrong. So why are they still in position of authority? Anyway, from January 2020, and that's kind of the pre-COVID era, right? That was before we decided to stop our economy and print a bunch of money and give it out to people so they wouldn't work. We have increased our money supply by 41.6%. So if we're looking at total inflation since the pandemic, you could say 41.6% will be the adjusted price hikes from January 2020 at some point, right? And it may some assets or some expenses or goods might go up at different rates at different times. Like think of how lumber went through the roof for a while and used cars caught up, and now we're going to see the food part go crazy. And actually there's a lot of meat processing and so forth that's already showing that. But 41.6% inflation, and this is just from money creation, okay? So this is just one piece of the puzzle, and that takes us over to the balance sheet. So the Federal Reserve buys a bunch of treasuries typically and monetizes that debt and either injects it into the economy or holds on to it, right? And so in this case, we're talking about what have they held on to, and even more than that, during COVID, they decided they were going to start buying bonds from the regular market. So they were actually buying a lot of high yield bonds, which is why we were very heavy in high yield in the last year or so, and made a fortune because it was risk-free. If it looked like it might default, the Fed wanted it just to take that risk out of the system and hold on to it themselves. Well, now they've got a decision to make on what to do with all of these assets. So currently, they're at $8,939,199,000,000 just sitting there at the Fed that something's got to happen with, right? A month ago, it was $8,962,474,000,000. I forgot to say billion in there, but whatever. So this is the first time we've seen a negative, right? And this is where a lot of April's results showed up. Oh my gosh, they're actually going to sell this stuff. It was always kind of a quantitative tightening, and the first step was that they would buy less bonds. Now, not only are they buying less in terms of treasury output, they are actually selling into the secondary market through investment banks and so forth. So we see for the first time a contraction of the balance sheet. Okay, well, this is a little start, right? We'll see how much more we got to go. A year ago, they were at $7 trillion. $719 billion, $622 million. So in the last year, they've increased their balance sheet holdings by 15.8% since January of 20, from 4.17 trillion. They're up 114%. They've more than doubled the amount of holdings on their balance sheet in response to the COVID shutdowns. It's not because of the virus, it's because of the lockdowns, right? We had to do this to protect things for something. Yeah, that's my soapbox. I will steer clear of going too much onto that. So anyway, let me illustrate what's got to happen here. As they continue to sell, the market is like, oh my gosh, you're going to flood it with all of these new assets. That means that, if you're selling a 1% treasury and interest rates are going up and I can get a 2% treasury, you're going to sell this $1,000 bond or whatever that you bought during COVID for 50 cents on the dollar. You're going to take a 50% hit. So obviously this is an inflated number because it was bought in a low interest rate environment. And so as these get sold, they get sold for pennies on the dollar in a higher interest rate environment. Well, what does that do? That increases the supply in the market of bonds, which means all prices go down. And that's why you see the 10-year treasury yield spiking through 3%. It should. Honestly, when I have retirement clients that come in, traditionally we would put them in long-term bonds. They would make a 4% yield of interest, right? They're living off 4%, so they're not spending their principal. And it was long-term bonds. We might use some dividend-paying large-cap stocks like Coca-Cola or whatever. Duke Energy comes to mind in this area as well. So it was just like, duh, this is how you run your retirement. You've been responsible, you've saved, you've produced for the economy, you've given back to your neighbors and communities, and now you've got your Social Security and you've got your normal interest rates. Life was predictable, right? And the economy was booming back then. The real economy, not the GDP that's offset by money printing. That's not real growth. That's actually it's an interesting graph. Sorry, rabbit hole. So the thing I wanted to illustrate here is if we do this math, we just subtract out from 8.962, 8.939, we get $23.275 billion was sold from the balance sheet of the Fed into the, I'll call it economy, market, right? It's money now coming from a closed off part because the Fed's not, doing auto loans and they're not selling food or buying pencils or anything like that. This is just new money that's entering the economy, entering the market, entering the system. So as it's being sold off their balance sheet, it actually turns into circulating currency. Okay, does that make sense? However, it's worth looking at the fact that they sold 23 billion, and if we come over here back to the M2 money supply, they created 59 billion. So what's actually happening here? Well, this is obvious. We're creating more inflation by 0.27%. But this inflation that's been kept segregated from the economy is also entering the economy. So when we call it quantitative tightening, are we really doing that? Are we tightening our policy or are we increasing liquidity? We talked about Bullard and Brainard and saying that they needed to raise rates and sell some of the balance sheet. They started that. The market spooked in April and got terrified of the fact that they're really going to do this. They're really going to raise rates by 75 basis points in June. Well, they took that off the table yesterday on May 5th. And but this is a net increase. We are increasing the amount of cash in the system, as Neil Kashkari told us we should do. We have an infinite supply. We're going to make sure there's enough cash. Well, they're doing it. And is that good? Well, this was never good to begin with. So they're trying to unwind one decision, which is going to make the consequence even more obvious. So when people are saying to me, how much more inflation is there to go? Maybe halfway, maybe 2/3. I'm going to stick by those numbers here. But yeah, we created another 9% in the last year. So that's also got to come out. And that's also been parked over here. So these are working hand in hand. There's a reason I've been tracking both of these now instead of just the M2 like we've always been doing. But yeah, this is kind of interesting stuff. And just be ready to spend more for the goods that you currently get. And whether or not you're going to get enough take-home pay to offset that hike, it's probably not likely if you're not making a lot of money. So anyway, yeah, we'll come back and we'll do the actual market performance, which used to start all these videos. That was kind of the point of these videos, and I feel like people care about that the least. They just want to understand kind of what's happening, what it's coming from, and where it's going. So we'll be back with that final segment. Okay, we're back. We're going to do the asset classes. I've been saying that today's the 6th. It's actually May 5th. Sorry about that. But anyway, you can see all the red. I'm holding the red marker this time. I normally carry around the black one, but yeah, all equities are down. That's been interesting. So we're negative 4.28, large value, negative 7 blend, negative 17 growth. Maybe there was a bubble there. I don't know, which has been calling it. Mid cap value down 4, blend down 6.5, down 12.26 on growth. Yep. Small, negative 6, negative 7, negative 13.5. International down 6.4. Emerging markets down 5.5. Real estate down 4. Gold down 2. All the bonds are down. Oil is up. Commodities are up. Seriously, go back to that September reallocation video. Start at 5 minutes and 40 seconds and watch roughly a minute of it. Yay. We're actually kind of happy about not the fact that clients' money is down, and that's been the theme of our second quarterly meetings here is I start the meeting and say, well, I'm super excited, but you lost money. Yeah, this is where you separate the people that know what they're doing from the people that don't. So yeah, just to cover the bonds real quick, down half on short terms, 2 on intermediates, 9.3% loss in 1 month on long-term bonds. That's called interest rate risk. As they raise interest, long-term bonds will drop. Yield curve inversion, all that stuff's playing out here as well. Tips are down 2. That's frustrating. I didn't expect that. That's the one thing I was wrong on. High yield's doing what they should do. They have risk because the Fed's selling. They're not buying now. So in the last month, the moderate portfolio, according to Dow Jones, is down 6. S&P is down 8.7. We are down under 5. That's pretty cool. Year to date, the moderate's down almost 11. S&P's down almost 13. We're down almost 8. Yay. I know people say, well, you're still down money. Okay, well, you know what? I've preserved like a lot of dollars for people because of how we do things around here. So I'm super thrilled to see anybody can make money in an up market. I mean, we learned that with GameStop, right? We learned that about Tesla and Apple and people not understanding what a stock split is. But it's how do you minimize catastrophe? That is the name of the game. And anything, honestly, like, you know, making great just a little bit better. Yeah, okay, is that worth it at the expense of certainty down the road? No, it's not. And so we have to have something that preserves value. Obviously, we're down money year to date. We're down buying power, thanks to the Fed and the Treasury at that, and Congress for spending. But yeah, so everybody's down. Everybody's standard of living is hurting. Yesterday's very high increase of 3% across the board in equities was just erased this morning. So yeah, this will be interesting. I do want to mention Twitter. Elon Musk is hilarious. Is it a good investment? I don't think so. I think half of the country is alienated either way. You're either pro free speech or you're not. And so if he's trying to attract a new market and increase the reach of Twitter and maybe sell a bunch more ads, well, you're losing the other half. So is it a good financial move? Probably not. But he's hilarious for really starting the conversation. So I'm going to end with that. This has been a long video. Deal with it. If you made it this far, congrats. Let me know you made it this far. That'd be kind of cool to know. There might be 1 or 2 of you. But I enjoy doing this stuff. And this has been really awesome to look back on over time to see all of the stuff that we called correctly September reallocation. We got another reallocation coming up. I'll do another update on what we're doing because it looks to be like there's only one player when you have insane amounts of inflation and decreasing GDP. So stagflation. Come back next time. We'll see what happens in May.